Reverse mortgages are one of the most misunderstood financial products in Canada. You've probably seen the TV commercials.
You could get up to 55% of your home's value in tax-free cash. Take only what you need in a lump sum or over time with no monthly mortgage payments required.
Or heard opinions from friends and family, and a lot of it is either incomplete or just plain wrong. I've been on both sides of the table, helping clients as a mortgage broker and even helping my own family use a reverse mortgage, which turned out to be a complete game changer. In this video, I'm going to walk you through exactly how reverse mortgages work in Canada and when they might make sense, so you can make the most informed decision possible for you and your family. What is a reverse mortgage in Canada? In simplest terms, a reverse mortgage is a loan secured against your home that lets you access up to 55% of its appraised value in tax-free cash without having to make regular monthly payments. Instead of making payments and reducing your balance like with a traditional mortgage, the interest is added to your loan balance over time. The loan is typically repaid when you sell your home, move out, or pass away. Eligibility requirements: to qualify for a reverse mortgage in Canada, you must be at least 55 years old, and if more than one person is on title, both must meet the age requirement. The home must be your primary residence, meaning you live there for at least 6 months of the year. You also need to have a certain amount of equity in your home, though the exact amount depends on your age, the home's value, its location, and current interest rates. Generally speaking, the older you are and the higher your home's value, the more you can access. Because of the maximum amount you can borrow is capped at 55% of your home's value, most borrowers maintain some equity even after many years of having the reverse mortgage. How you can access the money. One of the most appealing features of a Canadian reverse mortgage is that the money you receive is completely tax-free. You have flexibility in how you access it. Some people choose to take the entire amount as a lump sum, which can be useful for paying off an existing mortgage or covering large one-time expenses. Others prefer to receive the funds as scheduled advances, such as monthly, quarterly, or annual payments to supplement their retirement income. There's also the option to take a combination, a portion upfront and the rest in installments, giving you the ability to match the structure of your reverse mortgage to your financial needs and lifestyle plans. Who a reverse mortgage works best for in Canada. Reverse mortgages tend to work best for three main types of people. The first is those with an immediate need for funds, such as covering medical expenses, making major home repairs, or helping out a family member financially. The second is retirees looking for a lifestyle boost by freeing up cash flow, for example, by eliminating an existing mortgage payment, so there's more money available for travel, renovations, or everyday living expenses. The third is those using a reverse mortgage as a strategic part of their retirement plan, allowing them to avoid drawing from registered investments too early, which could trigger significant taxes, and instead using home equity to bridge the gap until the income sources kick in. What happens when you pass away in Canada? Reverse mortgages are non-recourse loans, which means that neither you nor your estate will ever owe more than the fair market value of your home when it's sold. When the last borrower passes away or moves out permanently, the loan becomes due. At that point, your heirs have options. They can sell the home and use the proceeds to pay off the loan, keeping any remaining equity for the estate. If they wish to keep the property, they can pay off the reverse mortgage from other funds or refinance it into their own name. If the value of the home is less than the amount owed, they can simply walk away without any additional financial obligations, thanks to the non-recourse protection in Canada. Here's a real-life example. I recently worked with a couple in their early 70s living in Ontario. They owed their home outright, but most of their wealth was tied up in the house. they were living on CPP and OAS. And while they were getting by, they didn't have much flexibility for extras like travel or helping their grandchildren with their education costs. They decided to take out a reverse mortgage on their home. Their property was valued at $600,000, and they were able to access a lump sum just over $250,000 tax-free. With those funds, they did three things: paid off the $40,000 in outstanding credit card and line of credit debt, immediately freeing up hundreds of dollars per month in cash flow. Set aside $100,000 in a conservative investment account to provide supplemental monthly income. Used $30,000 for long-needed home renovations to make the house more accessible as they aged. Before the reverse mortgage, they were stressed out about money and felt limited in what they could enjoy in their retirement. Afterward, they had no monthly debt payments, a fresh source of income, and peace of mind knowing they could stay in their home as long as they wanted. For them, the reverse mortgage wasn't just about money, it gave them freedom and quality of life. In Canada, a reverse mortgage can be a flexible and powerful way to unlock your home equity without selling your property or taking on monthly payments. However, it works best when it's part of a broader financial plan that takes into account your income needs, lifestyle goals, and estate planning wishes. If you're considering one, it's essential to run the numbers carefully, have open conversations with your family, and get guidance from a mortgage professional who understands how these products work in the Canadian market. This is Rasha Ingrata, Mortgage Agent Level 2 with Mortgage Intelligence since 1999 here in Windsor, Ontario. Thank you and have a wonderful day.